up the floor to Catherine Flood, who is from Scottish Mortgage. And as I said, this is probably one of the most exciting funds in the market at the moment, especially with it heading rapidly towards the £11 billion mark. I suppose the first question is, how's it been so well?
Good morning, everyone, and thank you, James, for having me on the programme. I think it's going to be impossible to look at the last 12, 18 months and not have the thoughts dominated by the near-term impact of the pandemic and the lockdown that's necessitated. But really, there are two big underlying trends that are clearly reflected in the Scottish Mortgage portfolio, one of which has been accelerated, we think, across a range of industries by the measures we've all had to take in lockdown. And really, that's the digitalization of the economy. So you've seen it in food distribution, in retail, where we're moving to use e-commerce retailers and entertainment systems, obviously also communication systems. So we have Zoom in the portfolio that's proved very popular and seen a real uplift in the number of people using them. But these are trends that were already going on. So I think the bigger areas are that of food retailing. So both people doing their grocery shopping online for the first time, swelling the numbers using services like HelloFresh meal kit delivery. And so the question for us is, although a number of the companies that we hold have seen an uptake in their services, what we're trying to do is take that step back as long-term investors and say, right, how enduring is this going to be? Are the people who use these services for the first time likely to continue to use them? What can we see from the patterns that were already emerging? And I think, this is a global fund, and the patterns that we can see here in the UK around that are even more extreme in China. So we hold a company called Meituan, which has peaked recently at delivering 30 million meals a day as people in China have been in lockdown and ordering food. But it's also moved from simply ordering food from restaurants, but to ordering grocery shopping through that channel as well. So you can really see that the pickup in their services, but actually their long-term ambition even before this was to reach 100 million meals a day. We also own a company called Delivery Hero that operates across 40 countries, doing something very similar, predominantly in emerging markets. Again, you can see a pickup in their services, new restaurants coming onto their platforms. And really what we want to see from the management teams of any of these companies that we hold is that they're being thoughtful about the long-run investment in their businesses. We believe that companies will be judged by the way they behave through lockdown. Are they actually helping? So from Meituan through to the large e-commerce platform Alibaba in China, you've seen them really supporting the businesses that are using their platforms, trying to protect both their customers and their employees. So Meituan has been using some robots that are using their autonomous driving to be able to deliver without having delivery drivers. Alibaba has been looking to support small and medium-sized enterprises that use this platform through either low interest rate loans or zero interest rate loans. Is just a small example of what they've been doing to try and support people through the difficult times. Closer to home, you've seen Amazon focus on delivering not the broad range of products across its board, but on the essentials that we've all needed to access when that's got harder as high street retailing has had to close. They've been paying their employees more. They've been heavily investing in the growth of their business to keep up with demand as far as possible by employing more people and investing in the long-term growth of their business, $4 billion rather than being short-term greedy in terms of trying to take profits now. And that's really what we want to see in any of the companies. And it's been reflected to some extent in the share prices that we've seen and them coming back after the volatility in March. But really, we think this is picking up on underlying trends that were already taking place.
So do you think the story getting stronger, if you like?
Yes, and I think it's reflecting a change that was already taking place. For certain, there will be a near-term rise as the alternatives are much more challenging to use. So what we're trying to do is take a step back and say, what do we think this will do to the long-run structural rise in the take-up of these services rather than looking at the near-term numbers, which is what we do as long-term investors investing on 5 to 10 year time horizons. We very much focus across a multiple range of scenarios. You know, what might happen? How likely is that to be? How much would this company be worth if they succeeded? What happens if they were good but not quite at the pinnacle? And we look across that spread of risk and returns. You're talking about a probability adjusted returns on the upside and comparing with that to the risk of the capital we have invested. One thing we do know as long-term investors, and we've been going for a very long time for Scottish Mortgage and for our other clients at Baillie Gifford, is that in these difficult times, the first and foremost challenge for all companies is to endure.
Yeah.
And the best companies at enduring are those with flexible management teams, by which I mean those who are not thinking about a 3-year incentive package, but who are running their businesses for the next decade and beyond. So undoubtedly, some of the companies in the portfolio, like the luxury goods companies caring, are having a more challenging time near term, but we know that the management team there, Mr. Francois Pinault, etc., are very experienced at this. You know, they've been through these sort of tough times before. They run their business in a very thoughtful manner on a long-term time horizon. They're thinking about issues such as sustainability, and managing businesses through these challenging times is how you get these enduring growth businesses. I think the other thing we have as long-term investors who see ourselves very much as owners of these businesses rather than renters of the shares speculating on their share price moves in the near term is that importance of building a relationship, of reaching out at times like this and saying, you know, we are supportive, you know, let us know what you need, but actually trying not to put undue pressure on them to deliver in short-term measures, when we know actually it's the long term that makes difference. And I wonder, James, if there's an example here that might be helpful. So back in the financial crisis, we held Amazon, share price fell, but actually Amazon was providing its consumers with what they were looking for. Consumers were ever more price sensitive in more challenging times, and Amazon just offered a better option than they could get in Main Street in the US at the time. We also know that in that period, Amazon invested very heavily, as they are doing now, in the long-term growth of their business. And actually, it was really that cemented their competitive advantage. That willingness to look through periods like this, to think about how you manage cash flows as a company, to keep investing, that really makes a difference to how businesses endure and grow in the long term, which is what we're looking for Scottish Mortgage.
But do you think, I mean, because of that, because of the situation we find ourselves in, and the fact that these companies can grow, it doesn't feel like everybody's piling into these stocks and the share prices are just zooming ever higher. And some people are saying, well, are these things sort of hitting bubble territory? So it's sort of the fangs.
So I think this is something that we would say, you know, you have to, more than ever now, you have to look at individual businesses, because each individual business will have to respond to the crisis, and it really does come down to the microeconomics. So if you're seeing businesses that are seeing an increase in demand for their services that not only allow us to meet the challenges, but we're all facing in this much broader real world challenge around the pandemic, but also about whether having experienced the services they offer, does that give their consumers something better than they can get elsewhere that leads to a long-term increase. You know, that does mean that ultimately these businesses on a long run free cash flow generation are more valuable. I suppose one technical point is that then those future cash flows, if you look at the discount rates, if you think that investment discount rates should be lower, and therefore those cash flows are going to be in present value terms more valuable because central banks will have to keep interest rates lower for longer, then there's an additional point there. But really this is about the business fundamentals. That's not to say that there won't be challenging times or that it's equally spread across the portfolio. And I say first and foremost, we're thinking about, you know, do these management teams have the ability to endure through these challenging periods, and we're supporting them through that as far as we can.
Cool. Okay.
There's a second area that I think might be worth talking about, which is wider and had already been going on, and you've been seeing the impact in terms of various share prices, which was the change in energy generation. Mm-hmm. So the move to renewables has been slow, but we would say in some senses much more predictable than share prices. So we know that over the last 40 years, the cost of solar has decreased by 99%. And, you know, that J curve in this sense, in terms of cost falling, you know, does become pretty predictable. And the impact of that on the long term for the hydrocarbons business is really quite tough. Transportation is well an illustration of this. But in May last year, 2019, for the first time, the UK went a full week without using coal to generate power in 130 years. And it might be interesting to listeners to know that the first point of that coal generation was in 1882 with Edison's first plant at Holborn Viaduct to power street lighting in London. And all throughout the period of 130 years since then, up to May last year, coal had always been in the mix. And I think we've been saying for some time that, you know, the tragic reality is that pandemics are more frequent than changes in energy generation. That structural shift that comes with such a big revolution like energy generation switching is really very important, and that companies that have been focused on paying out cash to shareholders in terms of dividends to meet income requirements have been doing so at the expense of reinvesting in their business to continue to evolve as the world around them changes, and have struggled to innovate to keep up. And I suspect the car market is the one where most people are familiar with the impact of this.
Yeah, I was going to ask you about Tesla. So
yeah, happy to talk about Tesla. But I think there's an important point here. You know, we can come on to Tesla specifically, but whether Tesla succeeds or not from here, it's clear when you look at, and China is now, if not already, going to become the largest car market in the world. And that has very clearly made a decision that electric vehicles are the answer to their challenges around pollution in large megacities. And that's a challenge that really, you know, existing incumbents need to meet. And we've seen that from the history of Kodak onwards, that's something that companies struggle with. And if you want a sort of a clarification of how big a challenge this is, you might want to look at the comments of Herbert Dice of VW earlier this year, who gave an estimate of 33 billion euros for Volkswagen to produce around about 26 million electric cars over the coming 9 years. Now, that's an awful lot of capital required. And we would say this is absolutely what we've seen at Tesla. We knew when we invested that car production is a capital-intensive industry, and that has factored into our analysis. Tesla have been building out their production. The difference between them and the incumbents, of course, is that if you're an existing internal combustion engine manufacturer, you have to give up a sale of an internal combustion engine largely to then sell an EV just to keep going, whereas Tesla can fundamentally grow its business because it's starting from a production run from the Model S to the Model X to the Model 3 and beyond, where it's fundamentally growing its operating business and benefiting from the scale without having to make existing assets redundant.
yeah.
But I'm sure you have other questions on Tesla.
Well, yeah, we'll come back to that maybe. But I suppose the other big thing that differentiates Scottish Mortgage is the degree of unquoted investments that you have in the portfolio. So I know that you're asking investors now whether it's okay to go up from 25 to 35 to 30% maximum. That's right, isn't it?
Yeah.
So I suppose some people just intuitively think that unquoteds are riskier. Do you want to dispel that myth?
So I think it's something that we think in investment more broadly is quite important, that you don't use sort of heuristics without challenging them. So I would say that the real difference here is between early stage businesses and those that have developed a business model and are still growing but have an established business. And for Scottish Mortgage, what we're trying to do is maintain our investment opportunity set so we can keep doing what we've always done. You know, when we bought Amazon back in 2005, it had a UK pound sterling valuation of something in the region of 15 billion. But the notion that it would succeed and put Barnes and Noble and Borders out of business was laughable to anybody you said at that time. Our point was not that the central case was that they were going to succeed, that they would become what they are today. Our point was, from the valuation you were being asked to pay at that point, if they succeeded, if they came anywhere close, if Jeff Bezos made anything like the everything store that he was aiming for, you would make a multiple of your investment. And that had to be set against the risk to the capital you had invested. Now, clearly, you don't put 10% of your portfolio into the company at that stage, but all you try to do is really capture the companies at that beginning when you've got a clear steer of what the business might look like. You can start to think about where their total and addressable markets might go, what margin structures might look like, what that would do to cash flows, how do they fund the business, start to look at getting to know the management teams. And then over time, as they progress, the likelihood of them succeeding gets higher because they now have experience, they have more cash flows, they're more established. And so that balance really starts to shift in your favor. As Tom said in the annual report, Amazon is not our largest holding because we can't think of anything else to buy. It's the largest holding because when you look at it on that probability adjusted upside compared with the risk of Amazon going completely out of business today, it's even more in favor than it was back in 2005. But we're still looking to do the same thing. The challenge is that many companies are at that stage today, and Meituan, that company I highlighted earlier, is a good example. They're private companies now. Most public investors can't get hold of these sort of companies at that similar stage to really benefit from that long-run compounding of returns that we know really drives equity market returns if you're prepared to be patient in the long run. When we bought Meituan in 2015, had a similar valuation to Amazon when we bought it. It was a same sort of stage of development, if not more so, but it wasn't available to most investors because it was still a private company. It was sort of roughly 3 times that size when it became a public company listed in Hong Kong, and it's even bigger now. But we know that long run impact of getting in at that stage is really important to doing what we're doing for Scottish Mortgage shareholders. I think the other thing to stress is that what we're trying to do with the investment policy, and you kindly mentioned the change, is give clarity to shareholders of what they're buying when they invest in Scottish Mortgage. This is not a target. It is a limit at time of purchase on where this might reach so that shareholders have a clear picture of what we're trying to do for them. Our largest private holding is in Ant Financial, which is the financial services platform which has come out of Alibaba.
Yep.
The company now transacts more transactions per day than Visa does, a multiple of the number of transactions that Visa does. This is a very long way away from venture capital, 2 guys in a shed. And I think that's what really people have to focus on, is the existential risk of the company. How early stage is it? And for us, what we're looking for is just to maintain what we've always done, which is get in once you've got that established business model, but before the market really appreciates where these potential companies could reach.
Yeah. Well, I suppose that comes to my last point on the slide here, which is obviously you were taking stakes in companies and they were growing and they were seriously impacting the portfolio when Scottish Mortgage was a lot smaller. Can you get the same results with it now at 11 billion quid?
Yes, I think so. And again, it comes back to this is about long-term investment for 5 to 10 years. So you want to see the next Amazons coming in at the smaller positions while the company really starts to try to execute on its extraordinary ambitions. But we also have Amazon, and as large as Scottish Mortgage is, if you look at the open-ended funds that invest in global stocks, they're much larger than Scottish Mortgage is today. And with respect to Scottish Mortgage, we could sizably increase our holding in Amazon and Amazon wouldn't notice. The same is true of all of our large holdings. That unlisted company that's our largest unlisted is $150 billion plus valuation. Again, although it's a material investment for Scottish Mortgage today, even if we doubled that size of holding, if Scottish Mortgage was fortunate enough to double its assets, it really wouldn't be material in the overall size of these companies. And I think that's the difference. It's not getting lost in the public-private debate. It's about looking at the kind of companies that you own and saying, is this got the potential that we're looking for? And then taking meaningful stakes for the trust. We believe in backing our long-term convictions so that we can really see the benefit of those returns at the end portfolio level. There's no point in having 0.5% in something that produces what we produced in Amazon and keep trimming the flowers and watering the weeds. But there's plenty of capacity to invest more in these existing businesses if Scottish Mortgage got larger. Okay,
cool. Okay. So let's start running through some questions then. I suppose the first one actually is probably quite common. When do you decide that something's too expensive? And how do you go about selling it? Do you trim it, or you'll sell it all in one go? How do you get out of something?
Yeah, that's actually a really good question, because at the end of the day, we're not just looking for good companies. We're looking for good investments that offer us the potential to make the sort of returns that we're looking for, which is that kind of ability to become a multiple of its size over time. But at some point, they will reach a point where they remain great companies. And I think here an example might help. So we bought Apple at the height of the fear and loathing of all things discretionary in the global financial crisis, so in early 2009, because we really thought that that new product, the iPhone, was something structurally different, that it had a potential to be much broader than just a replacement for your Nokia or your Sony Ericsson, and that therefore the potential returns available from Apple for this as it grew were extraordinary. However, we got to the stage in Apple where it was already the world's biggest company, and for us what we were saying is, what new products can Apple produce that means it's not just going to grow more than the market, but has the potential to become twice as big and then twice as big again? Because iWatch is a fantastic product, but at the scale of Apple, it wasn't going to be sufficient to make it twice the size of the company it was, and therefore it's not what we're looking for Scottish Mortgage. It wasn't a surprise, for example, when we were selling out that business, to see Mr. Buffett moving in, because it did have a dependable stream of cash flows with a really high loyalty to an extraordinary brand. So it's something about being disciplined in what you can offer, and when you get to the point where it's done that, but we can't see how we make that return potentially in the future, then it will be time to sell those holdings. I think you also have to be open and candid and say, look, sometimes we sell holdings because they just didn't work.
Mm-hmm.
Two scenarios there. And the first is the one which actually, from a psychological point as an investor, is the toughest thing, where it really goes catastrophically wrong. And I think I would draw a line here between the public market and the private, because sometimes we get asked and say, well, look, in the private markets, if it all goes wrong, you can't sell out. To be honest, the notion that if it all goes suddenly horribly wrong in the public markets, that you can get out and still be paid 100 pence in the pound, it is simply not reflective of reality. So you're really looking at saying, actually, that skew of risk and return, psychologically you focus on the ones that go wrong, but actually what makes the difference to your long-term returns is not missing out on the ones that make you a multiple of your money. Mm-hmm. And it's very, very hard to do, but you have to be honest and say, of course there are going to be ones that don't work. That's in the nature of looking at the way we invest, embracing uncertainty and looking at possibilities and probabilities, and frankly sometimes we'll just get it wrong. The third one I think is the most challenging, which is where a company is a great company. It's doing a little bit better than the market. It's very sound. You're not going to lose sleep, but something has structurally changed. And again, maybe I can give an example here. There's a Dutch enzyme maker called Novozymes, great company, but where we saw the potential for it to be much, much larger over the next coming 5 to 10 years was around demand rising for biofuels.
Yeah.
Now, as we saw the renewable energy generation and critically static battery storage starting to come through, we thought the potential over the next 5 to 10 years for biofuels had significantly shifted. And therefore, no reflection on the company itself, but the potential future end addressable market for Novozymes had just changed. So we ended up selling out. Now, we didn't sell out in one go. We gave it time. We're holding these contentions as I said, possibilities and probabilities. We don't think that investors should be trying to hold their conclusions too firmly, that the world changes too much for that. You have to think about that spread of risk and return. So yes, we do tend to sell out over time rather than immediately in those sort of businesses, and that's fine. We're really looking for capturing the majority of that upside.
Cool. That leads me neatly into some Tesla questions. So I think the first one here is an obvious one, which is how much of a risk is the CEO, and how do you factor that into owning it?
So I think this is one which is really interesting. We tend to demand that our companies are, and I don't mean we Bailey Gift or we Scottish Mortgage, I mean, as an investment group, we tend to demand that companies never make a misstep in the public market. And that's just not possible. When you're looking for something that is extraordinary, you need extraordinary individuals who run those companies. And that's true from, Jeff Bezos, Jack Ma, and a whole range of, I mentioned François Pinault before, and I would add John Elkann at Ferrari Fiat into that. But again, they are extraordinary individuals. And I think you have to say there's a difference here between, what Mr. Musk has created in Tesla and more recently, I'm sure people have seen the fantastic news of the launch over the weekend from SpaceX. Is they are impressive. There are limits, however, and we have been prepared to say publicly where those are. And so what you want is a candid and open relationship. But, it takes somebody with the extraordinary understanding of Mr. Musk to create companies like Tesla and SpaceX and the Boring Company. You need that kind of mind to be able to create this sort of opportunity. Most looked at the opportunity in the car market and said, I'm not prepared to take on the incumbents. But history shows it's actually those who are extraordinary that really drive these outstanding companies. And I guess you could add Bill Gates to that and look at the change to the broader world that Microsoft has driven. And Microsoft has been a fantastic investment on a long-term basis, for decades now, because it's bringing a structural change to the world. And there's really only a few companies that can manage those sort of challenges.
Okay.
For itself, the engineering is extraordinary. You look at the car magazines, these cars are extremely well thought of in terms of...
Well, actually, I've got a question that says, there's been some question marks over the build quality. Is that true? It's not something I've seen, but...
So in general, the reviews out have been pretty glowing in terms of the capacity of these cars to perform. And I guess, that's what we have focused on. Mr. Musk is an individual who has an ability to think at the broadest level, but also to obsess about the small details. And you can see that in some of the design features of Tesla. The interesting things that we think is a challenge to the wider industry, and which Tesla benefits from its structure, is that Tesla is very highly vertically integrated, which means they control a lot more of the component parts that go into their cars. Yeah. So if they do need to change something, they can do so much more rapidly. They don't have to then reach out to a distributed supply chain and convince them to do the necessary operating capex to change things. They can just, and they have a 3D printer that they use. So Tesla really has embraced all the technologies that are available to help develop their efficiency, which is what you want to see at the end of the day when you're investing in a car company.
So this sort of linked, but the existing manufacturers know how to produce in volume. Is still learning to do that? Do you see risk there?
Again, I think this is a run on the details. So they know how to produce internal combustion engines in volumes, but the engineering challenges are different with an electric vehicle. They are, pun intended, software driven, which is a different engineering challenge to high temperature, high pressure, 1,000+ moving parts in a small area. That is where you see for internal combustion engines. So Tesla, this is exactly the challenge that we had as our investment case. Again, going back to when we first invested back in 2013, they've made the first challenge of making a commercial production run in tens of thousands of units. But absolutely, Tesla was a much smaller holding for us because it's a very big challenge to go from 10,000 units to 100,000 units, which is what you saw them do in the Model S. And then as they've managed that, and you can see the learning curve from the Model S to the Model X, what we're pleased to see is the acceleration in that learning curve from the Model S to the Model 3 through to the production at the Shanghai facility. They went from breaking ground to production in less than a year. That's extraordinary in Shanghai. So they are already going through those challenges. And that's why you see a difference in the level of the holdings in Scottish Mortgage, not just for Tesla. They grow over time as that balance between the risk to capital invested starts to swing in your favor as companies gain experience, gain scale to fund themselves, to meet that next challenge, to keep growing, but then add in new addressable markets that mean their opportunity set gets larger, so the potential probability of adjusted upside starts to get larger as well. And so it's that balance that determines how large things are in the portfolio. And you've seen Tesla move up as a result of that. And what we saw in terms of it towards the end of last year was that shift in cash flow generation for Tesla that you really need to see coming through.
Yeah, big thing. And but just kind of linked to what we were talking about before, but given the amount of dialogue, public dialogue that there's been about Tesla, how popular Baillie Gifford have been in supporting it, can you change your mind on it now? If, you know, realistically, if you start selling it, everybody's going to notice. Are you now wedded to it regardless?
At the end of the day, we are investors investing our shareholders' money, and in any company, there is a need to challenge ourselves, but there's also about being open with the company. So if we take it away from the more contentious and say, you know, we build relationships with companies as the board at Baillie Gifford. So for example, we held Rolls-Royce and Scottish Mortgage, and we believe in being long-run constructive shareholders. And I don't think it's revolutionary to say that Rolls-Royce have gone through a challenging period, and they saw Mr. Warren East come, and we've known Warren East from his position at Arm Holdings, where we've been large shareholders until the takeover. You know, we did think that there was a challenge there for Rolls-Royce to overcome, but that Mr. Warren was the right person to do it. We were supportive of it. And it then reached a point where, again, it comes down to Scottish Mortgage is looking to offer something very specific, which is committed long-term investment in these companies in a concentrated portfolio for those who are willing to share our patient approach to investing. But the idea is that it has the potential to be some of everyone's portfolio, and it's not intended to be all of anybody's. Other strategies in Baillie Gifford have a broader remit in terms of what they're looking for. Still long-term growth investors, but there is a spectrum. So there came a point when we had a very open dialogue with the company and said, you know, Scottish Mortgage, this is no longer what fits into our portfolio, but we remain supportive shareholders for Baillie Gifford. And I think it really does come down to being that sort of open dialogue with companies. And then in terms of the practicalities, then, you know, that's part of the talent and the requirement of being a fund manager as to how you manage that. But it's really about thinking about that asymmetry, as I said, capturing the upside. And like I said, we're not going to be perfect in getting out in companies like Apple or others in the portfolio, timing right at the top. We're really looking to make that long-term return.
Cool. Okay. Just to finish up with, slightly to left field one, have you thought about listing on the New York Stock Exchange or in the States, appearing to a wider set of investors?
So Scottish Mortgage today is obviously the largest investment trust listed on the London Stock Exchange. We're not only a FTSE 100 company, but now reasonably high up at the FTSE 100. Have boosted the profile. You know, for a number of years now, we've seen investors from overseas considering Scottish Mortgage, and anybody who can buy shares listed on the London Exchange is able to buy shares in Scottish Mortgage. And we are mindful of servicing all of our shareholders right across the board. But I'm sure if we were going to list on the New York Stock Exchange, there'd be one or two announcements that you'd see coming out from the company.
Yeah, cool. All right, let's wrap it up there. Otherwise, we could go on all day, I think. But thank you very much for that. It's really very interesting. I know that you've got shows coming up with the managers of the fund as well, haven't you?
Yes, that's great.
When's the first one of those? When's the first one of those? Is it in a couple of weeks' time?
So the first one of those is next week.
Okay.
People are very welcome to sign up. There are details available. They can contact Baillie Gifford for those details should they wish. There's one next week with Tom Slater, and one the following week with James, to give people the opportunity to hear directly from the fund managers, as well as myself. And so the first one is on the 11th of June with Tom Slater at 4 p.m.
Yep.
And the following week with James Anderson.
Yep.
That is on the 17th.
Okay, good.
At 12 o'clock. Details are available, and you will need to register in advance to participate in those webinars, but we'd be delighted to see people join so they can hear more about the portfolio.
And we are chatting again next Tuesday, I think.
That's correct, yes.
To Master Investor attendees. So that should be fun too. Look forward to that. And then actually, next week, I've got one of your colleagues coming on to talk about Baillie Gifford UK growth. Thanks very much for today. And if we've got any other questions, I'll forward one to you. Thanks very much. Cheers.
Thanks.